Okay, so section 2 in chapter 10 is the principles of saving and investing. Yesterday we talked about the reasons, kind of that you should save first, get enough money in your savings, and then start investing money. That way you have your savings, which are liquid. You can pull it out quickly if you need it. And then you invest because it's risky. You have to make sure you have money in savings first, or you want to. I shouldn't say you have to. You can do whatever you want, but you want to have money put away. That way, in case you lose it, you still have money in your savings account. Because so we're going to talk about the risk. The more risk you are willing to take, the higher the potential returns. So if you're willing to be risky, you could make a lot of money, but you could also lose a lot of money, potentially all of it that you invest. So you have to kind of be careful. Chapter 11 will talk about like low risk, medium risk, and high risk investments, and we'll do some things to kind of look at potentially where you think you fall, and how much risk you are willing to take. Return on investment is a performance measure used to evaluate the efficiency of an investment. I know you guys already looked at that with Mrs. Morgan, so I'm not going to spend much time on it. But if you do feel like you need more help on it, maybe you didn't get it when she went over it, or you just need more practice, let me know, and I'd be happy to kind of go over some of those with you. And I think we're going to do a couple at the end of the day on Thursday for people. If you get it, you could go, and if you don't get it, you'll stay and I'll go over them. But again, return on investment is the return you received, how much money you make, divided by how much money you invested. So this is from the book, example 1. You bought an investment for $500. You received dividends of $18 for the year. So you gained $18. So your return on investment, you do 18 that you made divided by the 500 you invested, and you get a 3.6 annual return. Pretty straightforward. Example 2, I don't know if you did any like this with Mrs. Morgan, and it's not too big of a deal. We're not really going to do any. I just want you to see this. So if you bought an investment for $525 on March 1st and you sold it on October 1st for $525, so you made $25, which would make your return on investment 5%. However, that was only for 7 months, not the whole year. Typically, your return on investment is going to be annually. So you take that 5%, the 0.05, and divide it by 7 months times 12 months. And then you'll see that it was an 8.6% annual return on investment if you had kept it up the whole year, at that same trend. Again, just know if it's not for the whole year, you're not actually calculating a return on investment for the annual, which is what we've been looking at and will continue to look at. All right, so what types of risks do investors take? So there's an investment risk, which is the potential for change in the value of an investment. And then inflation risk is the chance that the rate of inflation will rise faster than your investment rate of return. If that's the case, then your investment is losing value. It's not actually gaining anything, which is what you want when you invest your money. You want to make money. A bond is a debt instrument that is issued by a corporation or a government. Basically, whoever the bond issuer is, they are borrowing money from that investor. So the government does it sometimes. They sell bonds. And if you personally buy it, then you are an investor to them and they're going to use your money. But a bond that's paying 5% when inflation is 7% is losing money. Okay. Industry risk is the chance that factors affecting an industry as a whole will affect the value of an investment. So, for example, say you have an investment, you bought some stock in some oil company. If oil as a whole rises, then that's going to be good for you. But overall, if the price of oil falls, then because that's the industry your stock is in, then your stock would fall. So that's a risk with any industry. Political risk is a chance that actions taken by the government will affect the value of an investment. So if the government makes a new law that will affect kind of where you have your investments, that's when you should be concerned. For example, California, I think Newsom passed a law that says, I could be wrong on the year, I think it's 2025 that California is going to stop selling gas powered vehicles. So if you have stock in gas companies, maybe you have stock in a car company, those might be severely affected by this new law that will take place down the road. So there are market and non-market risks. Market risks are the chance that the changes in the business cycle will affect the value of an investment. So we talked, I think, way back in chapter 1 about the business cycle and how it peaks, the recession, the recovery. So typically, if the economy is doing well, then your stocks and investments will typically do well. If it's going down, that's when stocks may go down. Non-market risk is the chance that events unrelated to market trends will affect the value of an investment. So terrorist attacks, natural disasters, those are non-market risks that we can't control, but they have an effect on the stock market. Additionally, right before the election, there was some uncertainty. The stock market then drops at times like that. Company risk. So stock, which is ownership interest in a publicly held company. So what company risk is the chance that activities or events that affect a company will change the value of an investment in that company. So if there's a strike or a product recall, something that negatively affects that company, then chances are the stock of that company will go down in value also. And then investment risk versus gambling. So the book quotes, if you can't afford to lose, you can't afford to play. So game of chance or gambling is not a good investment at all. You have a less than 50% chance of winning. That's how casinos and lottery and things make money, because the chances of you winning isn't in your favor. So even if you do win, sometimes typically the overall gain is not more than the overall input or your loss. So investing is different than gambling. And then tax advantages of investing. So a tax deferral, we talked about this back in maybe chapter 3 when we talked about taxes, is a postponement of taxes to be paid. So example, IRAs and 401ks are plans that allow you to defer paying taxes on those earnings until you withdraw the money during retirement. So again, IRAs and 401ks are tax deferred. You don't pay money when you put into those. You don't pay taxes. You pay it when you take it out. Typically, when you retire, you're in a lower tax bracket. Remember, your tax bracket is based on how much money you make. So when you're making money, you're in a higher tax bracket. When you retire, your income or the money you make is solely what you have pulling out of these retirement plans or Social Security or other things that are paying you. And then tax exempt, different than tax deferral, is an investment that is not subject to taxation. For example, US Treasury securities and savings bonds, those are tax exempt. You don't pay taxes on those earnings, which are good for people in high tax brackets. And then this last slide is just for today, is just an example. So an investment comparison. So on the left, we have a taxable investment. So if you buy a corporate bond at 7% interest, so if the investor pays federal taxes, the investor, that's you who's buying it, at a rate of 35%. So that means you would keep 65% of the earnings. The other 35% is paid in tax. So of the 7% interest, you get to keep 65% of that. So 7% times 65%, that gives you 4.55% earnings after taxes. So even though it was a 7% bond for interest, you only get to keep 4.55% of those earnings. Whereas a government bond is tax-free. So if you bought a government bond at 5% interest, you keep that 5% interest. So that would be the better investment in this situation. Obviously, you'd have to look at the interest rates and the other factors, kind of the term length of the bond and everything. But there are situations where the tax-free or the lower interest rate, I'm sorry, is the better option than a higher interest rate because it's tax-free. But again, we'll talk more about those when we get into chapter 11.